Today's guest is David Foley. He's the Senior Managing Director at Blackstone and the Global Head of the Blackstone Energy Transition Partners Group. David, you joined Blackstone in 1995, and you've really played a central role in both building the energy platform there and investments across both traditional energy and especially more recently, the energy transition. So first of all, thanks for being with us.
Great. Happy to be here, John.
I'd love to hear what's changed most in private equity over the time you've been there.
So I think in terms of what's changed most, I started in 95, most people were generalists. We do buyouts of, I think the first couple things I worked on at Blackstone, I worked on a toy company, then a telecom company, then a funeral home, but like all kinds of different things, just as a generalist investor. And one thing that's changed significantly is it'd be very hard now to find a private equity firm that didn't have areas of expertise, industry specialties, healthcare, energy, tech, consumer products. And I think in a very legitimate way, you know a lot about what's important to that industry. It's, technological innovations to the extent it's impacted by regulatory stuff. You're already familiar with that. You've done a mapping, you know who all the competitors are. You have a view. So that is now table stakes. So if you don't have that and you're competing in a auction process with someone who does, you're going to be much slower because you're still trying to figure it out, whereas they already know it and they can focus on the management company. So that's one thing that's changed, industry specialization. I think another thing that's changed is there's a lot more players and bigger, like every range from like small to big. And so it's getting more efficient. Finance is, everyone's looking to get excess return and money flows, like water to where they think there's a imbalance, where there's a vacuum. And so the firms that are doing better at it maintain some degree of differentiation, right? What are you actually good at? How can you build a moat and through your reputation, relationships, maintain a bit of an edge? I do think that private stuff is still less efficient than the public market. And because it is committed, undrawn capital on the occasions when the public market's dysfunctional and locks up, like global financial crisis, coronavirus, we can and do try to step in when the public market's freaking out and may overvalue things on the upside, but the same is true on the downside and kind of take advantage of that. So I'd say those are some things that have changed. But in terms of things that have stayed the same, in terms of creating value, the importance of management teams, and the difference between A and a B player as a CEO, like night and day. The importance of business quality, like is it actually a good industry? Some industries are inherently don't produce returns for shareholders. I can't believe they keep on getting funding. They kind of do. So I think business quality remains an important thing. And I think understanding the macro tailwinds and impacts of regulatory policy are still important, maybe even more so, because it just seems maybe after 30 years, it gives you some perspective, but it seems like the pace of change is much more rapid.
So what I want to do now is talk a little bit about the portfolios that you manage these days. So I feel like you were quite early in building out dedicated energy transition funds. So I'd love to go back to when you started to do that. Why did you think that was important versus traditional oil and gas private equity portfolios? Would love to hear sort of the genesis of that.
So, we've been doing energy deals since 1997. So, from the start, everything's looked at through a fiduciary lens. And so in the case of current funds, we're a fiduciary that actually, as it turns out, because of the scope, has a really positive environmental impact and impact on communities and employees. And in a way, that really streamlines things because there's no misalignment at all. And I think it can be harder sometimes for broader fund managers where energy can be a cost and if the first bit, like if you're going on a diet, losing the first few pounds isn't that hard, but try to get to net zero, it's harder. And in some cases, there may not be an obvious economic return to shareholders or investors of that next notch down on if you're focused on reducing CO2 emissions. But for us, because most of the companies we're invested in, whether they're on the electrification side of it or it's on the molecule side, we are helping our customers with making electricity more affordable, reliable, energy security, safer, and cleaner, right? Not absolutely clean, but better. And so if we're successful in getting more customers who want a transmission line built, they want battery storage, they want solar on their roof, they want to run their factory but use less energy in doing it, that's revenue for us, it's profit. And we're helping the broader economy, massively decarbonize it.
As you were talking there, that brings us to probably the chunkiest topic I'd love to talk to you about is energy demand. And so with AI, with data centers, with reshoring, manufacturing, an aging electrical grid, I would love to hear your perspective on how, in some ways, how we as a country, but how in particular Blackstone Energy Partners can help play a role in sort of bridging this gap on energy demand where we are right now. So would love to hear you sort of share how you're solving for that. Some maybe with some examples would be lovely to hear.
That's a big topic. So this is going to take a while, but we're happy to go through it. So electricity demand is now growing after decades of not. It's not all about AI. I'd say if on average in the US, the growth of the next few years is, and this isn't going to sound exciting at all, like 3%. Maybe 3.5%. In some industries, that's pretty boring, but you got to unpack it. So about 2% of that has nothing to do with AI at all. And some of that last percent is just cloud computing. So again, not necessarily AI, but the 2% is, onshoring, nearshoring manufacturing, a bit more industrial economy, the early returns from energy efficiency having been made, again, like home insulation, windows, all that. So it was growing anyway. But it's the addition of the hyperscalers for whom the highest value of a megawatt hour in the US is absolutely, for data centers and AI, they'd pay, if they could get it, triple what, an average, residential
Like a consumer. Yeah.
industrial user would use. But getting back to your point, electricity demand is growing for all these reasons. And because I think the industry and utilities were lulled into this false sense of, hey, what's the problem? Everything's great. Demand doesn't really grow. We've got a big cushion. Everything's good. We need to pay a dividend. So do we really need to invest all this CapEx in our transmission grid? Maybe next year. So we've had 15 years or so of electricity prices, residential, commercial, industrial, growing at less than the rate of inflation. Little to no increase in electricity prices. That changed a lot. Like last 5 years, it's almost doubled in a lot of locations, including a lot of locations, by the way, with no data centers whatsoever. So, it's due to, policies, state policy, perhaps overly aggressive shutting down of existing assets, perhaps because of, CO2 related focus, net zero objectives, or just because they were old, and not investing in the transmission grid. Because you should think about the transmission grid in a way as a substitute for new generation, because it's hard when you use a national average, that 3% national average. You can't wheel the stuff around easily. So in Northern Virginia, where there's a ton of data centers and there's economic growth, or Texas, where it's a very pro-business state, low tax rate, as it turns out, very efficient solar, lots of wind in West Texas, cheap gas, a lot of data centers going there. So a lot of economic growth, demand growth much higher. So that creates stresses individually. And if you had a very efficient grid, you could just wheel power from where there's more of it to where there's less of it, and you could avoid the need to build a new power plant. But we don't have an efficient grid. So at the same time, utilities are trying to play catch up from decades of underinvestment in the transmission grid, which is stressed now because there's no reserve margin. So long story short, we've got a huge latent demand wedge, which is built. And some of that's obviously the data centers. And that is in part why, back to my upbringings in being an economics major, supply and demand always meet. It's just a question, what's the price? So with those price signals, there's now a lot of focus, capital being formed from the regulated electric utilities, from private capital, and clearly the government is recognizing this is an incredibly important thing.
I think you talked about the how do we expand that supply of electricity without the consumer prices going up? That's a sort of a big conundrum or challenge. You also talked a little bit about the need to work across jurisdictions and alongside governments. So you've certainly done that. Maybe some examples would be helpful. I know there was a big one that took maybe 10 years to come to fruition, working with the New York State. That would be maybe a good example of how can private capital in partnership with government sort of help bridge this gap and deliver this additional electricity we need.
Sure. So permitting in the West is really a challenge, and so the example you're alluding to, Champlain Hudson Express, is the name of a 1,250 megawatt high voltage direct current transmission line that we're building. It'll come online this summer, actually, from the border with Quebec into Queens. Actually, I can see the substation.
Oh, wow. Yeah.
And so the good news there is it's reliable. You never get reliable on renewables, really, but because it's being aggregated at the border, Hydro-Quebec is the one providing the power from wind and hydro.
Okay.
And the great thing about hydro is if you want more of it, you just like lower the sluice gates a bit, the turbine turn a little more because you got a reservoir.
Yeah.
It's still probably the most cost efficient form of electricity storage we've come up with in the last, since electricity was invented, actually. Sadly, it's regionally specific, right? You can't build a hydroelectric dam just anywhere. So they're an investment grade counterparty. They have a lot of excess power in Quebec relative to the population. So they were looking for markets to deliver that power to. And a dozen years ago, we were introduced to an entrepreneur from another developer that we were working with on conventional power generation, who had this idea that was the reason why it ultimately got built, and the reason why a lot of other transmission lines to bring power from Canada into New England or New York have failed. And that's kind of because when people think of the "not in my backyard" phrase, the thing that prompted that, high voltage transmission lines, they're visual, you can't hide it. It's very visually obvious. And, all else equal, people are like, put it in the other guy's backyard.
Yeah.
Which doesn't really serve the greater good for the greater number, for the country. And so the brilliant idea that the entrepreneur had was, okay, great. It'll cost more, but if we bury the line and we go down Lake Champlain and the Hudson River, we can get it almost all the way to New York City with it not being in anybody's backyard. It's fewer individual permits, because the challenge with a right of way is if you're missing one segment, you don't have a transmission line or you don't have a pipeline, right? So any one landowner or county, can essentially block it. And so that part worked great, and Hydro-Quebec's been great to work with. But the reason it worked, which gets back to the answer to your question, is very much a public-private partnership, very closely working with the mayor's office in the city, the local utilities, New York State, reaching across the border to our friends in Canada. And it's not just Canada, but Quebec, a little bit different than Canada, and the trades. We had all electricians. The IBEW loved it. A lot of work, skilled labor, and getting it done. So it's worked out great.
Could you share a couple of examples, some projects that exemplify what you're trying to accomplish?
Sure. And since the strategy, I think, is pretty consistent, but how we apply it, it's not narrow. It doesn't fit tightly in a traditional asset allocation bucket. So we'll both develop, supervise construction, own and operate critical energy infrastructure assets. And that might normally be done maybe in more of like a value-added infra fund. Value-added because we're not just buying it, right? We're taking the risk to build it. But we also do buyouts, and we like growth companies and equipment manufacturers as well as service providers. So I'll try to give you an example of each. And the first one is actually an investment in our first fund. Although we invested in energy before the first dedicated energy transition fund, that came about in 2011, so about 15 years ago. And that was a hard asset that we developed. So Cheniere, which existed at the time as a importer of natural gas. And in 2011, I was approached by the CEO at the time who we previously turned down on the regas facility to import natural gas. And sometimes adversity is the catalyst for creative. When you don't have any options, you get really creative.
Creative, yeah.
So Sharif didn't have any money, and since he didn't fully contract the regas facility, the credit, position wasn't so great. But what we did have was a phenomenal site at Sabine Pass where they'd spent billions to, have a pipeline come in. They had a deep water dock, they had gas storage, and he realized that one of the reasons why the regas wasn't working so well was gas prices, which people thought were going to be really high because we were running out of natural gas in the U.S. Like if you ask anybody, consultants in 2008, 2007, we were running out. We'd have to import more. And then shale happened, right? And it turned, well, no, we've actually got an infinite amount of the stuff and it's cheap. So he probably, was like distraught for a while, but then, said, well, I've got this site. It saved me like a few $1 billion if I turned it into what would otherwise be a greenfield liquefaction facility. Because I've already got the pipeline, I got the dock, I got the storage. I just need a lot of, compression just to kind of chill gas, freeze it basically, and send it out.
Yeah.
So we committed $2 billion back in 2011, 2012, which then helped them raise $6 billion of debt and give them credibility with off-takers, big major oil companies who want to make sure, who was standing behind the project is Blackstone. So that worked out. And we got Bechtel to build it for us, lump sum turnkey. And that came online, the first trains of LNG 5 years later. So Cheniere is now the largest exporter of natural gas. Yes, $50 billion they've invested in it. The industry produces over $40 billion a year of revenue for the United States, helps minimize balance of trade, several 100,000 jobs. I'm really proud of that. So we created something that didn't exist, and now it's a huge, huge industry. And when you think about what that does for us as a country, half of the exports from the U.S. went to Europe in 2024 to keep our allies safe and from freezing because of the war with Russia. Yeah. And it's a great way to monetize a resource we have a lot of, which is natural gas, and decarbonize areas that would otherwise be using coal. A second one, and I'll try to get, so that was my hard asset example. A second one, which was in Fund 3, Legence, is a engineering business. We bought that in 2020. So I knew the CEO from, he was COO of a prior business, liked him a lot. They design, engineer, and maintain high specification HVAC systems. So heating, cooling, ventilation, mechanicals, plumbing for built space. Not like just regular office buildings, right? But if you consume a lot of energy, so it's a big part of your cost structure, investing in the latest equipment and design to use less of it, like be more energy efficient, big returns, right? So as it turns out, data centers have been a great customer base for them. Also, pharmaceutical manufacturing, where you can't have the temperature vary by too much. Semiconductors, where you don't want any dust in the air. So we bought the company, and since then we've quadrupled the EBITDA. We did 24 add-on acquisitions. So think about that, in 5 years, like 24 add-on acquisitions. And we didn't do that because the company wasn't growing. The organic growth rate was like 16%. It was on top of that. They were accretive. We changed the brand. It was originally called Thermo. We called it Legence. We hired 5 new executives who are now part of the senior management team. It's been great. And we took it public last September. And then from an equipment standpoint, one of the first deals in Fund 4 is a company, and we do invest globally. I mean, the fact is most of it's in the US, North America, but this was one headquartered in France called Sedever. They make glass insulators for the electric grid. It's a transmission grid. And if you've ever been going down the highway, you see the big, transmission structures, the stuff that looks like little glass discs hanging in a row. Oh. That's what they make. And so they have lots of patents. It's the premier product. If you're in a country that has much lower labor costs, or you're not worried about fires or safety, you can use porcelain or ceramics. But if you're concerned about those things, use glass. It's a premium quality product. They've got a high relative market share. We bought it in the fall of 24. And so we saw the demand for the product, and we moved quickly and we bought it. The EBITDA went up by 50% in 1 year. We knew they were going to run out of capacity, so we've already put in place. We're looking for opportunity to expand capacity in the United States. We bought a second glass furnace in the Czech Republic to complement the facility in Italy. We've added a line in China. And importantly, too, sensitive, like the Chinese facility produces product for China and Southeast Asia. The European facilities produce product for Europe and export a bit of unfinished product to the US, which we assemble here and provide to US customers. So, sensible supply chains. And we saw the tremendous need for safer transmission. We've had some fires in the US in certain areas. And you need modern equipment. And if you can't get a new right of way for a new transmission line, it sometimes helps to safely upgrade the voltage on existing right of way, and you need new equipment for that.
So I was wondering if as you were talking there, are there any maybe over the last 10 years or so deals that got away? Ones that sort of when you think about a lot of people like to talk about their best deals, but any that you think are sort of misses, you're like, we wish we did something different.
Sure, there's always a few that got away. One was Westinghouse, which I actually bid on twice, to be fair. Over a dozen years ago, when it was first for sale, we were partnered with GE. GE had boiling water nuclear reactor technology. Westinghouse was pressurized water. And between the two of them, it's every single reactor in the US. So it was actually good idea. And we liked, it wasn't then like, oh, the US is going to build a lot of new nuclear reactors. It was that if you had an existing reactor, you really didn't have much of a choice in terms of replacement fuel rods, who was going to repair, maintain, spare parts kind of thing. So it was really that part of the business was quite good. But Toshiba, the Japanese conglomerate, bought it, paid a price that was more than we and GE thought it was worth. And then sadly for Toshiba, they like building stuff. So they decided they wanted to build nuclear power plants using Westinghouse technology, which was very good technology and still is. But the US permitting process and construction being what it is, that they made a mistake of guaranteeing a price, like lump sum turnkey for those reactors. And the US and in fact in the West, the history of building nuclear reactors isn't really an on time, on budget kind of thing. So the asset went bankrupt. And then the one that got away, so that one maybe didn't get away, but the one that got away was then when it was being sold by Toshiba out of bankruptcy. We thought, okay, we're not going to try to build anything. It's going to be a good business, and we can buy it. And they hadn't really run it that efficiently, so we thought it'd be cost savings. And we thought we had it. It was down to the final bid, and kind of out of nowhere. And really, I don't even think they were in the initial round. This is now like 6, maybe 7 years ago. Paid what we thought was a pretty full price. Like, and sometimes explaining nuclear and risk, to LPs, it's not the most straightforward thing. Although we have owned and operated a nuclear power plant before, worked out great.
Yep.
But in this one, so we lost that, and then subsequently, who knew? Now a nuclear renaissance, and they got a lot of cost out of it, and now the current administration wants to really try to catch up with Asia, particularly China's building, I think 38 nuclear reactors now. We're building none.
Yeah.
And I really do think it does play that technology does play a legit and an important role in energy transition. Zero carbon emissions, and when you turn it on, it's on, and that's part of the Achilles heel really for renewables.
Thanks, David. We like to finish these off with just a little bit of sense of, we've learned about your risk taking in the investment space. We want to learn a little bit about your broader perspective on risk taking. So we've got a couple of quick hits here, and I'd love you to share whether you are risk on or risk off these topics, if that's all right. So we'll start with, are you risk on or risk off on owning an electric car?
Yes, with an asterisk. I own a Volvo XC90, so it's a hybrid.
Oh, hybrid.
And truth be told, I also own an Aston Martin, which is fully, hydrocarbon powered.
That is not an electric car, no.
I got all my risk averse. I guess I got both bases covered. I got electric and non-electric.
Would you put solar panels on your house?
Yes.
You would, or you have?
Tried. So we have a home outside in New York City, which is primary. I don't have a roof really, so no, not an option. but we have own a home that's outside the city, and we we're putting panels on. The roof's not flat, but we're going to put panels on the property, and had it all done, and the people coming out to do it, and then we're told we didn't have a sufficient setback, so the local regulatory ruling precluded us from putting panels in the property because it's too close to the property line.
But personally, you're risk on. Just
Yeah.
another permitting thing. Um, permitting is the key theme. Uh, the next one I wanted to ask was, you're from Chicago, so would you swim in the Chicago River today?
No, far too cold. It might be covered with ice.
What about in the summertime?
Still wouldn't do it.
Still wouldn't do it. Okay, risk off.
Uh,
So we're both golfers by the sound of it. What do you think about putting windmills on the golf course?
well, one of my favorite golf courses to play, I'm not a member, but I have friends who are, is National Golf Links of America in Southampton. And they have a windmill on the golf course. I should mention it's probably been there for, 100+ years. It's wooden and it's inoperable, but it is a windmill.
So risk neutral, maybe.
Risk neutral.
We talked about a bit of a renaissance in nuclear energy. And you also mentioned the not in my backyard. So how do we feel about a small modular reactor landing in your own hometown?
In New York City, yes.
Thanks, David. This was fantastic. Like I said, we've called this podcast Without Boundaries, but we didn't just go outside of the boundaries. A lot of it was about looking around corners, trying to figure out what the next opportunity might be and how we solve for some of the biggest challenges in the country right now, supplying the energy that we need, the electricity we need. So thank you so much for your time, and we really appreciate it.
Thank you, John. I appreciate the opportunity to have a conversation with you today and the partnership with Russell and your investors.
Well, mate, that's our show for today. Remember, in your personal life and your investing life, keep breaking boundaries.
This podcast is intended for informational purposes only. The content provided within the podcast should not be construed as investment advice, research, or a recommendation, solicitation, or offer for any specific Russell investment or other product, strategy, security, or service. The information does not take into account the investment objectives or circumstances of any particular investor and may not be appropriate for all investors. All investments carry a level of risk and do not typically grow at an even rate of return and could experience negative growth. Any past performance results should not be seen as a guide to future returns. All opinions presented are as of the date of the recording and subject to change without notice. Information contained within the podcast is obtained from sources believed to be reliable but not guaranteed. Reliance upon the information provided in the podcast is at the sole discretion of the listener. The general information contained in this publication should not be acted upon without obtaining investment advice from a licensed professional. This podcast may involve discussions with non-Russell Investments personnel. The views and opinions expressed by non-affiliated personnel in this podcast are those of the speakers and do not reflect the policy or position of Russell Investments or its affiliates. This content should not be construed as a recommendation or endorsements of any third-party manager featured on the podcast. Some of the portfolio managers or firms featured in this podcast may manage funds or accounts that are offered by Russell Investments, and they may have business relationships with Russell Investments or its affiliates. Neither Russell Investments nor any of its staff accepts any responsibility for or liability with respect to the information or opinions contained in this publication. In EMEA, this content is suitable for professional clients only. Capital at risk. Copyright 1995 to 2025, Russell Investments Group LLC, all rights reserved.